So my next guest is looking ahead to 2026. Her and the firm just published a report, Escape Velocity. Joining me now, UBS Head of Global Equity Strategy and Management, Nadia Lovell. And first of all, Nadia, provocative title. Of course, I had to go look it up, you know. So Escape Velocity, the minimum velocity that a moving body, such as a rocket, must have to escape from a gravitational field of a celestial body, such as the Earth, and move outward into space. So we're not in space yet. It sounds like there's more potential for this market.
Well, I think it's important to also note that the title has a question mark. And Charles, you might not know this about me, but I studied physics in undergrad. That was my major, so I will help you educate you from a physics standpoint. That is correct definition. But how we're thinking about it from a question mark standpoint is asking those questions. Can AI innovation, easier monetary policy and fiscal stimulus really free the global economy from some of those constraints around rise in debt, deglobalization and shift in demographics? And we think that it can. I mean, in fact, we think that you're going to see very good earnings growth in 2026 and very good economic growth, something in trend line, 2% trend line growth. And that's going to help the S&P 500 propel it to 7,700.
It feels like, for instance, the demographic thing, that's a serious issue, perhaps one of the most important, but it takes a long time, though, right? So we've got room between now and maybe the worst case scenarios for those sort of things. Let's talk about the risk, though, because, your report does, as you mentioned, there's a question mark there, and you talk about politics and markets and some key risk.
Yes. Some of the risk, of course, is around the rise in debt. What does that mean for market? Do we see, geopolitical risks on the rise again? We've had this past year has had to deal with the back and forth around trade policy. Does that rear its head again in 2026? We don't think so, but these are things that we're watching. And then also the market has been helped a lot this year by the AI trade. Is that sustained in 2026, or could you see any sort of hiccups around that therefore destabilize the broader market?
We've been hearing about debt for a long time, the debt clock, the debt, personal debt, economic debt, all this debt, and it's always on the list of risk. It just feels like it never truly comes to fruition. Is that because of the role of the Federal Reserve?
Somewhat so. I mean, you saw that, when there was concern around rise in debt, you did see longer-term bond yields start to rise again. When we look into 2026, we think that this Fed is going to remain on the path for easy monetary policy and cutting interest rates on the short end of the curve. In fact, we think that you're going to get a cut in December of this year. As you talked about earlier, Williams really sent that home on Friday, and you're seeing a repricing in the market already around that. We think you get another one in the first quarter of next year. And then after that, the Fed will take a wait-and-see mode and eventually get to neutral. And we know that we're going to have a changing of the guard with the Fed chair later in the spring of 26.
It will become a decidedly more dovish Fed, at least at the top.
Exactly. So we are in the camp of easier monetary policy. And when you look at historically, what does that mean for the S&P? When the S&P is growing above, earnings growth above 5%, and you have a Fed that's easing, that usually translates into mid-teens return for the S&P 500. And so that's what we are expecting for 2026.
Mid-teen sounds delicious right now. Let's talk about the role of AI, okay? So some great tables in this report, too. And I like the 4 or 5, right? The estimated compute demand for Chat, GPT, Enterprise, and Agentic AI is it looks like it's going to go off the charts. The demand is going to be there. And then, of course, the revenue potential will come as a result.
Absolutely. When you look at the install base today, that alone would suggest that you can see a 25 times increase in chatbot. But that's not where the story is, as you can see in the chart there. It's really in the agentic AI as well as physical AI, which we think that if our projections are correct, you need 5 times more than what we have today. And we think ultimately companies will start to adapt AI even more. You've already seen from the U.S. Census survey suggests that 13% of large cap companies are using AI. During the last earnings season, 50% talked about AI. So we think over time, in the next couple of years, you're going to see more increased use of AI. The monetization, we're shifting our attention away from some of the CapEx. We still like that, but we think that you have the next leg of this trade is really on those who can monetize AI.
That's going to be harder to decipher, though, right? I mean, to your point, I look at these earnings reports. Everyone's talking about it, mostly in a positive manner. The companies, though, that can engineer it to the bottom line. But The MIT report that came out maybe 5 weeks ago that kind of for a while stalled this trade, only 5% return on investment. Do you think is that just early stage stuff?
It's very early. We're
Right.
3 years into this. Next year will be 4 years into that. You are already seeing in terms of savings from, customer service. You're seeing, better returns on investment for advertising. So we ultimately think that that's where the opportunity is going to be, and also from headcount reduction. Reality is this is going to be also associated with probably a smaller, more efficient and productive workforce.
Yeah. Nadia, it's a great report. I appreciate you coming in. Thank you so much.
Thank you, Charles.
Talk to you soon.